We have a lot to talk about today. I think that we should be starting with inflation because we got some new US inflation data today. So the number that came out for January was 7.5%. I've read that that's the highest since 1982. I don't think that these high numbers are really a surprise to anyone at this point, but I wondered if you could walk me through the reaction that we've seen from precious metals and perhaps reactions elsewhere in the market if you want to go down that path.
Yeah, I think part of the problem with precious metals is the way that they have not reacted to the inflationary numbers. Now, there are reasons behind that in and of themselves. Some would point to manipulation on COMEX, and I think that that's very valid. There's a lot to say about that. When we talk about inflation, I think it's important to understand that, in my mind, gold and silver represent the canary in the mine shaft. And so I think it's very, very important for the powers that be to mitigate the rise of gold and silver, even as all the other commodities are racing ahead, and supply chain problems from gas to coal to copper to oil are rampant. It sends a signal or a message to the public if gold and silver are flying in the face of record 40-year inflation. It sends a message that the dollar really is probably in as big a trouble as a lot of us expect, but certainly they don't want that to be mainstream news and mainstream understanding. So I think that the bigger issue is taking a look at the inflation numbers and trying to gauge what it means. First of all, it's important to know that when we talk about a 7.5% inflation number just came out on the CPI, that excludes things like food and energy and housing. John Williams of Shadow Stats, I know will tell us that inflation is closer to 15% if we use the old metrics the way they were measured prior to 1980, prior to being adjusted to fit an inflationary agenda. What's interesting is the reality of the predicament or the corner that the Fed has painted themselves into. And this is really, I think, what people are concerned about and want to know how it all plays out. And I mean, on one hand, you're damned if you do, and the other, you're damned if you don't. If they let inflation run like we've been seeing here lately, prices are going to very rapidly get out of control. I mean, if you're talking a 7.5% inflation right now with interest rates on the 10-year Treasury at 2%, the environment that we're not even 2%, almost 2%, 1.8 or whatnot. The environment that we're seeing is I don't think the Fed has any tools left to be able to fight this. So, and they're talking about raising rates in March. They're talking about selling off their assets and stop the asset purchase and even selling off their balance sheet into March and April. And if they do that and let rates really rise, I think that they'll be hell to pay in stocks and bonds and real estate that have reached all-time highs against all-time lows in interest rates. They're all inversely correlated to a rise in interest rates. And this is why I think the Fed can't do anything. In fact, I think that what they're going to try to do is let rates rise enough to where they have wiggle room. The world reserve currency cannot go nominally negative. I mean, it's already real negative in terms of its 5% or 5.5% negative real return. But if the world reserve currency goes nominally negative, there's a real big problem there. And so I think what they're going to do is let the interest rates rise. They're going to sell off some of their balance sheets. They're going to have a very hawkish rhetoric. And I think you will see the markets react adversely when that happens, as anyone's guess, March or April, as this all starts to unfold. I mean, heck, you got Powell talking not only that, but about only holding treasuries on their balance sheet. That's $2.7 trillion worth of mortgage-backed securities that would have to be unwound. So you're talking the three pillars of wealth: stocks, bonds, and real estate, all potentially being hammered with the rise in interest rates. So, the question is, do they sacrifice the markets or do they do what all politicians have done preceding, and that is to sacrifice the dollar? And I think ultimately that is what they will do. When we talk about inflation, I think it's important to note that they've been lying to us for a very, very long time. Aside from the fact, Charlotte, that rates are 7.5%, or excuse me, inflation is 7.5%, excluding so many of the things that are inflated, like food, like energy, like housing. We just saw a report issued by the Levy Economic Institute where the numbers from the 2008 through 2010 financial crisis were released. It was a Freedom of Information request, Freedom of Information Act, that went all the way to the Supreme Court. The Federal Reserve had these numbers sealed for 2 years and then decided to seal them for another 10 when, through a FOIA request, all the way to the Supreme Court, they were finally released. You know, they told us in '08 that they put $700 billion into TARP, another $700+ billion into infrastructure. And that is what we saw the Tea Party come of. The Tea Party was a reaction to the crazy $1.4, $1.5 trillion expenditure. That was considered obscene and ridiculous. They also told us they gave $3 trillion to the banks to bail them out, right? Well, what we just saw from the Freedom of Information Act and the released files is that that number was actually $29 trillion. And it was given to all sorts of commercial banks, including $2.5 trillion to Citibank, basically nationalizing them. And they are co-owners of the New York Fed. There's a problem there. It's very incestuous. But they gave money all around the world, to the United Kingdom, to Japan, to Germany. And we're seeing inflation prints in the UK, the highest since World War II. We're seeing in Germany, the highest in 30 years, the highest in several years. In Japan, we are spreading inflation across the globe. And I think that the moral of the story is that it, to me, and this precedes the COVID spending. This precedes the 2019 repo market spending. You know, we've been talking a lot about when we look at all the dollars ever created in the history of this country, over 50% of them were created in the last 2 years. You put it all together, they have chosen an inflationary path over austerity, over the tough decisions. And I have a really hard time believing that they will blow up the economy by letting rates rise. I think they will raise them just enough to freak everyone out, to give them some wiggle room, and then they will come back in and they will accommodate and they will stimulate and they will keep interest rates, they will change their path and go back to lowering of rates and more injections of money into the system. Because when you have bubbles like we have seen, super bubbles at all-time highs and all-time valuations, factored against the lowest interest rates in human history, if we see rates rise, it will be the perfect trifecta. And I think it will be not just a recession, it will lead us into a depression. So my guess is that inflation is here to stay, and there'll be lots more of it. And there may be a little bit of jawboning and acting as though they're going to get tough on inflation over the next several months. But I think as soon as we get near 3% on the 30-year, it's over. I think that the whole market throws up upon itself, and they go back to what all administrations have done, all the way back to the Roman days when they clipped the coins, and they will choose inflation and the printing press over the tough decisions. So yeah, I think it's going to be more of the same. I think we all need to buckle up and get ready for what I think will be an inflationary path when this is all said and done.
Okay, I think you're touching on so many questions that people really want to hear the answers to. So we have an idea now of what you think the Fed is going to do in the next months. How do you think that precious metals prices will react if it goes as you say? Because as you were saying right at the beginning of this interview, prices have not reacted in the way that people have hoped, at least so far.
Yeah, you know, I think that ultimately precious metals will react the way that we all think they will. If we go back to 2017, when we started to see central banks accumulate gold, we've seen the Bundesbank of Germany, the Bank of Turkey, the Bank of Poland, the Dutch National Bank, the Bank of Austria, the Bank of China, of course, the Bank of Russia, who now says they hold more gold than they do dollars in their reserves, the Bank of India, the Bank of Serbia. I mean, all of these banks are copiously accumulating gold. We're seeing massive withdrawals recently off of the London Metals Exchange and the Bank of England. I think in January, the numbers were 26 tons of gold taken off of the London Metals Exchange and the Bank of England, over 600 tons of silver taken off. We've seen repetitive deliveries off of COMEX, backdooring out of ETFs. All of this is being done in a way that sidesteps, in many respects, the reporting, the backdooring for the authorized participants out of SLV and GLD, the withdrawals out of the London Metals Exchange and the Bank of England. These things are not very well publicized. It allows the big banks, the big money centers, the sovereign wealth funds to reposition. They are repositioning and de-dollarizing and using the manipulated paper price on COMEX to run cover. You don't see these kinds of massive deliveries off of the exchange to the biggest money in the world if they don't expect the prices to go much, much higher. And when you talk about silver, I mean, Charlotte, look at what silver offers. It's a depleted asset, right? It's a depleted asset in nature. It's found at the very top of the surface in a form called epithermal, which means the big deposits largely were found decades ago, before the advent of advanced imagery. And so you have an asset that is depleted in nature, but has experienced a monetary renaissance, and at the same time has a whole slew of new green and digital applications that are coming online. You have 800 million ounces or so mined every single year, of which only 240 million of those ounces come from primary mining companies. Only 30% of all of the silver that comes to market comes from companies that specifically mine silver. It is depleting. 70% comes from other companies that are mining, copper and lead and gold and other commodities, and they stumble across silver. So it's an asset that is depleting. It is an asset that has expanding utility and needs in industry, and has globally experienced a massive wave of monetary demand and interest. So when you look at something that for thousands of years geologically traded at a 16-to-1 ratio, 16 ounces of silver was worth 1 ounce of gold. If you dug a giant hole in the ground 5,000 years ago, that's about the ratio that you would have found. And it was that way for a very long time. Over the last 150 years, we've seen a ratio of roughly 42-to-1 on average, and right now it's 80-to-1. The key to all of this, though, is it's coming out of the ground globally. It's 7-to-1 right now. So you have an asset that's massively demanded monetarily, massively demanded and expanding in demand in industry. You have an asset that's depleting in nature. It's becoming very hard to find, and it's priced at roughly 11 times overvalued in its relationship to gold right now based upon its geologic footprint. When you talk about where silver should be, when you talk about the massive deliveries we're seeing off of COMEX and the London Metals Exchange and the ETFs in silver, I think silver is buying opportunity of a generation. Now, with that being said, ultimately, I think gold is the place we all want to be. The reclassification of gold, its tier 1 reserve status, its massive acquisition by the central banks, its repatriation from the Bank of England and the New York Fed, everything points, as far as I'm concerned, to gold really being where we want to be in the end. But there is no question that silver offers you a pathway to getting more gold. I look at it as the most undervalued asset on the planet. You have everything in terms of assets at all-time highs because of the environment we find ourselves in, where so much money has been created and so much of that money has found its way into inflating financial assets. Yet silver is trading under half of its 1980 peak, as it's depleted in nature, massively demanded in industry, massively demanded monetarily, becoming harder and harder to find. I mean, where could you ask for a better backdrop? I don't think you can. So I think it's a mistake to try to say when it will happen, other than to say mathematically it has to happen, and it will happen. And even throw the mathematics aside, look at what the biggest money in the world has been doing for the last several years, quietly accumulating. It's massive deliveries 2 years in a row off of COMEX in both gold and silver. And I don't know, I think that before it's all said and done, it'll go higher than most people think possible in the light of a dollar that will be sacrificed to inflation in favor of blowing up the market. So ultimately, I think it goes higher, both go higher than people really even think possible.
Okay, and you know, this theme of looking at what are the large entities in the market doing, that's something that you left us with the last time that we talked about a year ago. And that
Mm-hmm.
ended up being our most popular interview of the year at INN. So obviously that resonated with people.
Thank you.
But yeah, so I know that, so people are paying attention to that, but I think that people are still having a little bit of trouble sometimes in knowing what to do in this environment. Obviously, we know to add gold and silver to your portfolio, but can you speak a little bit more about how people can look at what these large groups are doing and then prepare themselves as well?
Yeah, well, I look, I don't think you have to look any further than the information that is funneling its way down from the very top. I recently watched a video that was issued by the lead economist for the St. Louis Federal Reserve. And when I finished watching it, I'm like, we're screwed. We're screwed if this is the way that our leaders, our economists and the Federal Reserve think. And one of the things that they said is they said, look, people view debt from a household perspective, and that's the wrong way to look at it when we're talking about the national debt, which just eclipsed $30 trillion, which is, you know, when you talk about how big that is, that's 25% larger than the entire economy. That doesn't even take into account, of course, Medicare, Medicaid, Social Security, government, military pensions, and all of these things that exceed 100 trillion in unfunded off-balance sheet liabilities. But just looking at those numbers, you know, this joker went on to say that, well, you know, a government's lifespan is indefinite. So a government never needs to repay its debt within a finite period of time. It just needs to roll it over indefinitely. So talking about debt not having a lifespan, it's not a problem to pay it off. We can just continue to roll it forward. He went on to say that because treasuries, the debt instrument, represent a call or a claim on US dollars, that there's no reason that the US government can't just print more dollars. And so there's never an economic reason for the Treasury to ever default on its obligation and pay more dollars. So, you know, he went on to say that the national debt does not constitute a liability, or does constitute a liability of the US government, but it shows up as an asset somewhere else in our pensions, or investing in as a part of an investment in our insurance companies. The policies that we own, they invest in it. It's an asset somewhere else. And basically what they said was, or what he said was, this is not a burden on our children as it corresponds with an increase in household wealth elsewhere. So basically what you have is a government here, again, reinforcing the fact that they are going to continue to increase the debt. That means more spending. They're going to continue to inflate. They're going to destroy the value of the dollar. And I think you have to look at what the big money is doing, and they are acquiring gold and silver. They are exiting the dollar very quietly, using the rhetoric of gold and silver not performing in this environment to run cover for their accumulation. I think if you stay in dollars, you're destined to go broke. And I do think that being in the equity markets at this time right now is dangerous, because I do think the Fed intends on rattling the bushes. I think they're going to rattle the bushes so much that there's a cry for the Fed to come back in and accommodate. So I think that when you're talking markets at all-time highs, when you're talking the amount of money that's been injected into the system that's found its way into financial assets, when you're talking about a government or a Fed that is really out of options, they have two. It's inflate or it's default. So my advice to people, whatever it may be, is to get out of harm's way of the dollar. It doesn't just have to be gold and silver, but I think when you talk about valuations, there are very few things that offer the attraction, the appeal, the value that you're finding in metals right now. And for me, the mathematics and the economics are a good portion of it. Seeing what the big money is doing quietly seals the deal for me, because they always move a full 2 or 3 steps ahead of the crowd. And you really got to dig to see it. You really got to look hard to see the numbers. But if you look hard enough, you can see that the central banks of the world have been on a buying spree of metals for the last 4 years. And when you see a company like JP Morgan pay a $920 million fine for suppressing the price of gold and silver, yet accumulating over 1.1 billion ounces of physical silver and 35 million ounces of gold during this whole operation, only paying a fine which amounts to not even what their gold desk made that year. They made $1 billion that year, paid $920 in a fine. They walked away up $80 million. It meant nothing to them. But the question is, who are they accumulating this metal for? Is it on behalf of the US government? Is it on behalf of the Chinese government? Who knows? Why is Bank of America short 800,000 ounces of 800 million ounces, 800 million ounces of silver? Why? Why are they short this amount? That's a whole year's production. So look, all I can tell you is that ultimately metals go much higher, and the big money does not want us to see that yet, because it will crowd them out of their trade and will not allow them to reposition the way that they want. So I don't know. I think you first need to look at gold and silver not as an investment, Charlotte. You look at it as wealth, and you look at it as something that's outlived 2 world wars. It's outlived German hyperinflation. It outlived the Great Depression. It outlived every pandemic, and it's still wealth. It's immutable wealth. And you know, as I often say, in the year 3000, when the dollar bills that we have in our wallets are hanging from a frame in the Smithsonian, gold and silver will still have value. And that's how I look at it. So that's what people can do if they want to get out of harm's way, is start to de-dollarize the way that the big institutions and the central banks and the commercial banks and the huge amount of interest in a group on COMEX called the others. These are mostly they're managed money traders, mostly, I would believe, sovereign wealth funds and family offices. And they have made massive long purchases and over 2 years have literally begun draining the COMEX. So big money is moving ahead of what's coming next. And you put it all together, to me, I believe that gold will be central in terms of the pegging to whatever system comes next. Maybe it's a distributed ledger that validates the gold held somewhere and the backing of a currency. But with what all of the Western nations are doing to their economies and their currencies, no one will ever trust them again unless there is something like gold tied to it to give us all confidence that we won't see a repeat of what all politicians do, and that's choose inflation over tough decisions. And that goes back as far as time goes. That's what they choose. And it's a much easier deal to get reelected by inflation than it is through austerity and cutting entitlements, which, you know, in this environment could be a very scary thing, because you have a massive amount of inflation where the cost of living is getting very high. The wealthy, well, they don't give a crap because their assets, they've gone to the moon. But the people who are having a hard time making ends meet, putting food on the table, which has gone way up, putting gas in their car, which has gone way up, heating their homes, which has gone way up. This is a problem if you start to see this type of an environment. And so I think you do the best you can, and you start to slowly mitigate your exposure to the system. And if you choose gold and silver as a vehicle to do so, I think there's really no better choice. Farmland, a close second, something where you can produce food and have something that, you know, you can produce food for yourself. But in an environment where the cost of everything is going up so exponentially, I think it's a perfect storm really waiting to happen, Charlotte. So that's why I look at gold and silver as wealth, and so important to be a part of everyone's portfolio, no matter how many ounces you own, no matter how small a portion, you should have some. And I think this is the time to do it.
Okay, and following up on that, this is a question that you can definitely give us a detailed answer on. How easy is it right now, if you want to get your hands on gold and silver? What are you seeing at Miles Franklin? Are there products that are in low availability? Are you having supply chain issues? What are the premiums like?
You know, it's funny. I often feel like the little boy who cries wolf. I remember, you know, at the end of the story, the wolf comes, and I think people should realize that, because for the last year, I have, since March or April of 2020, I have been vehemently saying that this industry will be defined by the inability to readily source product. And it's getting really hard. In the 30 years I've done this, I have never had a more challenging, difficult time getting product. We're one of only 24 US Mint authorized resellers in the world. We have storage programs in Canada, so we're very intimately close with the Royal Canadian Mint. We're very close with the importers for the UK Mint, for the South African Mint, the Austrian and the Australian Mint. Getting product is ridiculously hard, mostly in silver. Gold is not hard yet. When I look at the volume of business we did last year, over $500 million, 90+% of it was in, probably 95% of it was in silver. Getting silver is becoming super hard. Gold isn't yet, because most people have been buying silver. So gold, actually the premiums on gold have come down over the last year or so, because it's something called the cost of carry. And that means if you hold a whole bunch of gold in inventory and you're not selling it, there's a cost for holding that, the interest cost, the cost of money. And so the premiums have come down on gold, but gone way up on silver. And I think at some point when gold catches this bid, a big bid, the same thing will happen there. But I've seen it many times over my 31 or 2-year career where all of a sudden, like that, stuff disappears. Now, I know Rick Rule, he's a buddy of mine, and he's told me many times and says it publicly all the time that right now, if you take the entire financial matrix from Joe Sixpack to the Harvard Endowment Fund and everything in between, gold and silver holdings represent less than 0.5% of all of the holdings in the United States. And so, the average or the mean over the past 40 years has been 2.5%. 8% in 1980, 0.5% now. The average is 2.5%. If we just got that far, that's a 5-fold increase in demand, and like that, it's all gone. And I do think that even though that we're high up on the food chain, I have 2 full-time employees that do nothing other than acquire metal. One works during the day here in the States. One works at night, talking to all the mints and the importers and across the globe, in Europe and South Africa and Australia, the United Kingdom. And it's a full-time job. It used to be something where I wouldn't even think twice. I'd call a distributor, and in 3 days, whatever I wanted would be in my warehouse. Half the time, they would say, here, we'll just throw it in your warehouse. You just leave it in there, and if you need it, it's there. If not, we may have you send it back to us. I mean, that's the way it used to be, not any longer. And I think you're seeing a greater interest globally, coupled with supply chain issues. You got our buddy Jeffrey Christian from Jeff Curry from Goldman Sachs on Bloomberg TV the other day, saying that in his 30 years, he's never seen markets like this where everything is in shortages: gas, oil, copper, aluminum, coal, you name it. And the same thing is happening with precious metals. You're just not seeing the price action yet, because the demand for physical metal is so far greater than the price would lead you to believe, and that's because of COMEX. And at some point, that has to break. Charlotte, I really do believe that the only way you can manipulate a market, really manipulate it over an extended period of time, especially one that is globalized as this is to push it in the direction it is going. And you have a whole generation of younger people who, even though they bought cryptocurrencies to get wealthy, most of them, not buying it to protect the way a lot of the metals people do, they understand the relationship or the dichotomy between fiat currencies and cryptocurrencies. They understand it. And so you have a whole generation of people who are waking up to the problems associated with fiat currency. And I think before it's all said and done, even the diehard crypto bugs will find refuge with a lot of the profit they make, hopefully, in gold and silver. And I think before it's all said and done, this market will be defined by the outside. People will look at it and say, geez, it's gotten so expensive, I can't buy it. Kind of the way a lot of people feel about Bitcoin right now. But by people like you and I and the people you talk to every day, it'll be more along the lines of, yeah, it's expensive, but you can't find it. You can't find anything. There's huge delivery delays, massive premiums. And that is what is coming, especially if we see some sort of an event where people all of a sudden snap awake and look around and say, my God, everything is crumbling. I need to find some safety. Like that, it's gone. So there is some availability now. Look, We're still in business. There are a lot of companies in business, but it is not the way that it was. And premiums are as high as I've seen them in 30 years. So, at least in silver. Is it going to continue? If I had to guess, I'd say yes. In fact, I think it'll get a lot worse.
Okay, and when we talk about all this demand, I think some people might think, well, okay, why don't the miners simply produce more? But of course, we know how hard it is to make a discovery, to bring a mine online. And miners are dealing with inflation now as well. So I wonder if you could comment a little bit on all of those factors on the mining supply side.
Yeah, in fact, you have Dan Dixon from Endeavor Silver. They just withheld 1 million ounces of silver from the market. Keith Neumeyer has done that before, but take 1 million out of 850 million, that represents like 0.1%. So, you know, first of all, people say, well, why don't the miners withhold instead of mining more? We'll talk about that in a second, because like when we talk about silver being epithermal, when we talk about the big deposits being found a long time ago, when we talk about that only 30% of the silver comes from primary miners, well, we could say it about gold, but let's just talk about withholding supply. You know, instead of feeding the beast and allowing them to manipulate it on COMEX, how about not give them any new material to fill their vaults with, the COMEX vaults, and see what happens? Well, you know, it's a cost-intensive industry, and it's getting more expensive with the rise in energy costs. But you know, when you talk about looking for silver in particular, you have to dig further, explore more, you have to expend more energy, because the low-lying fruit was picked a long time ago. So Dan withheld 1 million ounces. Sounds like a lot. It's, you know, almost $30 million, but that represents not even a tenth, just over 0.1% in global mine supply. So it's spitting in the ocean. And I don't know if producing more, of course, you know, yeah, produce more. I don't know that that's the answer. I think the answer would be to try and disintermediate the commercial banks altogether, to go directly from the mines to the public. I think would have a much better, and from the mines to the end user, like these Samsungs and the Tesla and the Apple, and stop using the financing of the commercial banks, stop allowing the commercial banks to manipulate COMEX. And I'd much rather see just a complete disintermediation, and I think would have a greater effect. Producing more, sure, I'm sure they'd like to produce more, but there's a finite amount out there, and it costs so much, and so it affects the bottom line. They're damned if they do, they're damned if they don't. I just think that it's one of these deals where gold and silver have been ignored for so long, and in favor of financial assets. It's given the cartel the ability to really do as they wish with the price. And I'll tell you this, and this is honest to God, the price is not reflective of the demand. And ultimately, I think a global wave of demand, as markets start to shake, will hopefully overwhelm the ability of these commercial banks, especially with the new Basel III reserve ratio requirements. That makes naked shorting very difficult, and not able to be counted on their balance sheets against equity positions. I think it'll make it much more difficult for them to do that. I think they'll have to think twice in an environment where inflation globally is running rampant, where markets are shaky, where people are nervous, where geopolitical tensions are at all-time highs. I think it's a very foolhardy endeavor ultimately. And when you look at a bank like Bank of America, who's so massively shorted, it could ultimately put them out of business the way it did Bear Stearns when silver went from $12 to $21, and JP Morgan inherited their position. And you know, Chris Marcus did an interview with Bart Chilton before he died, of Arcadia Economics, Chris Marcus, and it was groundbreaking. Here you had the former CFTC commissioner, a week before he dies, basically say all of this, that JP Morgan had been manipulating the price, that they were supposed to pare down their short position, but they in fact increased it. They thumbed their nose at the regulators, that they were suppressing the price, and it was complete and total antitrust fraud. And so the bottom line is that this stuff is happening. And I think these banks are skating a very, very fine edge, because in all the years I've done this, I've never seen more interest and more realization that, perhaps divesting of dollars and dollar-based instruments is something that should be looked at. One of the things that's very startling to me was the number of people that we did business with in the last year or two that have never, ever, ever owned gold before, never, ever owned silver before. There's an awakening, and it's gradual, but there are a lot of people who realize that it's easier to make money these days than it is to keep it. And when the markets start to really shake, I think that will certainly come into focus a little bit more, making it that much harder to get product.
Yeah, and I think that maybe one of the reasons we're starting to see that is because people can feel inflation in their everyday lives, right? It's not one of these large numbers that you see somewhere and it feels very abstract. It's in your day to day.
Yeah, I think it's actually taken on a more relevant. I think people are more concerned about it than they are the virus right now. I think it's probably surpassed that. People are beginning to really be concerned about it. Yeah, so that's step one, awakening, realization, and I guess we'll see where we go from there.
We will. And, you always bring such interesting perspectives to us. As we're wrapping up here, I wondered if there is anything else that you have on your mind in 2022 that you really think people should be thinking about?
I think that we can beat these topics into the ground. I think that it's, people get tired maybe of hearing the same thing over and over and over again, but I think it's really very important that we do, that people take a step back and listen. That look, we are a country that is $30 trillion in debt. And as I mentioned, 25% larger than the entire economy. We're a country that left billions of dollars of military equipment to the Taliban. We're a country that has really, never historically engineered massive high inflation, but we are now. We're a country that seems to be embracing socialism, the opposite of capitalism, which is being vilified, and that's what created all the wealth to begin with. We're a country that is divisive, and it's red versus blue and black versus white and rich versus poor and vaccine versus not. And I think people need to take a step back and realize that it's great to receive a return on your money, but a return your money, to me, is really more relevant in this environment. And one of these days, we've had a bull market run for the last 15 years, basically. But one of these days, things are going to change. We have the Buffett indicator right now at 211% of GDP. That's almost 65% higher than the long-term trend. We're seeing almost 3,000 bank branches closing this year. Are they preparing us for a cashless society? We're seeing the World Bank, the IMF, the BIS, 11 countries from around the world, and the US Treasury simulate what they believe is the greatest threat to the financial system. That's a global hack. You have the Federal Reserve Chairman, when asked what is the biggest threat to the US financial system, and he says a global hack. The wheels have been spinning so fast that I'm waiting for something to knock one of the wheels off, whether it be something geopolitically, whether it be something, by the way, and not to be conspiratorial, this same group that had this meeting, and it was in Israel, and 11 countries, and the Bank of International Settlement, the World Bank, and Klaus Schwab, this is the same group that had in 2019 simulations on coronavirus pandemics. Now, it wasn't on the virus that we have, but it was a coronavirus as the host, and a virus in a pandemic. And then 6 months later, there is a coronavirus pandemic. Now, this, I'm not saying it's nothing other than coincidence, but this same group just all got together and simulated a global hack as the biggest threat to the whole system. So there's threats everywhere. And I think if you look at this, it's very hard to see where it's going to come from. No one would have saw coronavirus looking at it in 2019. And I think if you don't take the time to prepare now, when it's so obvious, when the biggest money in the world is doing it, when the Fed is caught between a rock and a hard place, when they've chosen for forever to inflate, when they're saying they're going to get tough on inflation, they're going to rattle the market. There's no place safe to hide, with the exception of precious metals, in my opinion. So look at it as wealth, not as an investment, and start to de-dollarize, because I really do think there will come a moment, some seminal moment, something's going to happen to shake the system to its core. And this is why you need to mitigate your exposure to the system. And I would say start doing that yesterday, Charlotte. I really do think so. I hate being the purveyor of bad news, or pessimism, but there's a fine line between realism and pessimism in my mind these days, especially when you look at the numbers, the deceit, and the effort that is being used to keep people from seeing the truth.
Okay, I think that's a good place to wrap it up. Thank you so much for sharing your time with us and your thoughts today. It was great to hear from you again.
Charlotte, it's really great to be back. I'd love to come back sooner than a year this time, and I'm always here if you'd like to get some info on what's going on in the precious metals market. And I know that the Sprott conference is here in my hometown. It's actually right next door in Boca. I'm in Delray, but it's in Boca, so I won't see you in Vancouver this year, but maybe we'll see you down here in Florida if you get a chance to come down here in July for the Sprott show, Rick Rule's symposium. But if not, I'm always here, and it's always great to see you. Thanks a lot for having me.
Thank you so much. Hope to see you again soon. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Annie Schectman with Miles Franklin.